Good morning, everyone. It is 6 a.m., half an hour before the market is going to open on Thursday, May 9th. I don't know how much or how long this video is going to be, this analysis is going to be, because yesterday we were talking about how we're kind of bouncing back and forth, just going sideways in this market, and there hasn't been any real catalyst for us this whole week. And it doesn't look like we have a catalyst for today or tomorrow as well. So if that holds true and we continue to get low volume in this market, then there's really not going to be too much to say that's different from yesterday or the day before. So this might end up being a short session, but we'll see. So before, I guess the first thing that we would look at is futures and see how that is shaping up, and it looks pretty flat. NASDAQ especially at only 8 points out of 18. So that's basically not even 5 basis points. The S&P about not even 10, so maybe 6 basis points right here. And then the Dow at 20 basis points. So a little bit more significant in the Dow, but of course, all of these are comfortably in the random territory. So this morning we'd say we were randomly downward in the indices, so a random, somewhat downward bias, but still just random movement. So we're not going to expect too much movement. So far, this is not showing us anything different than what we've been saying over the last couple of days. And so far, it looks like we might just continue to chop sideways with low volume. Next thing that we'll look at is the pre-market. So pre-market, we got a little bit of a range, but not significant at all. Especially, it's well in line with the day session, which is normal for us. We wouldn't expect the pre or post-market sessions to be more volatile or have a more of a price action than the regular session. But you can see it's almost perfectly half. And we did come down and we did go back up, and then we ended up pretty much, it looks like we're going to open pretty much exactly where we closed yesterday. So it looks like here we did get a little bit of a spike right at 5:30. So there's probably a piece of news that did that. So let's take a look at what that could have been. Jobless claims. And that was the only thing that we identified yesterday. Is that, okay, this might do a little bit, but not really that much. We didn't expect it to change the trajectory of the market, but maybe introduce a little bit of volatility, and that's exactly what it's looking like so far. It's definitely didn't give us enough juice to say, hey, yeah, we're going to move upwards or we're going to crash downwards. All it did was spike us up a little bit in the pre-market, and then now we're just chopping at a different level than we were previously. So everything that we said yesterday applies. Everything that we said the day before applies. And the levels that we're looking at, excuse me, the levels that we're looking at also apply. So 518 to 512, that's the arena of operation that we're looking at. Yesterday, we were just call it 518 to 514 or 515. So a lot more muted than the range that we gave it. And I wouldn't be surprised if today was the same. Today, though, I would say maybe, given how futures are opening, more of a bearish lean, and also because of the length of time that we've stayed up here, a little bit of a bearish lean, and also because if we look on the daily basis, we'd see, well, if we're going to chop sideways, then we should probably move down a little bit, just get a red bar in there. It could be a green bar, but we're opening right where we close. So if we get a green bar, that would be, unless we just don't move anywhere to the upside and stay there, then that would be a little bit of motion upwards. So a little bit more likely that we're just going to move a non-meaningful amount downwards. So maybe just like yesterday, this 515 area. But of course, if we go down to 512, that's still going to be normal and mostly random. If we go down to 512, we're still above that, of course, right at the MA50. And so this chop back and forth between the 518 level and the MA50, that's really what we were looking at for this week. So far, nothing different. Let's take a look at VIX. Let's take a look at bonds. And if we don't, excuse me, if we don't see anything there, then that'll be it for this morning. Everything will be the exact same as before. So let's take a look at our VIX first. VIX is coming way down. We're very much in this range, this bottom range for 2024. We're actually in the middle of it. And it looks like if we just chop back and forth between, say, 12 and a half or 12 and this MA 200 level, which is not significant on a VIX. We don't care about averages on a VIX, but I'm just happens to be a good line on the chart. So I shouldn't call it the MA 200 level. I should call it 15. Okay, this is 15. If we chop between here and there, we're not going to mark it as significant. 15 and a half even, I would say, wouldn't be significant. All it would mean is that we might be drifting lower. And just because the S&P 500 goes down doesn't mean we have to have a spike in volatility. It might move a little bit up, but it doesn't have to go way up like we saw over here. We don't have to have a spike in volatility in order for the S&P 500 to move down. Actually, let's see that. Let me get rid of this. And what we see is, let me see if I can find a good example of, okay, so like this downward movement here wasn't associated with a spike in volatility. This downward motion here, I guess, was elevated versus before, but it wasn't huge. We wouldn't call that a spike. This is a spike. This is a spike. This is elevated, but not a spike. So what we see is like these baby moves in the indices, like right here. They're not associated with giant spikes in the VIX. Like smaller, shorter moves are not associated with the VIX. And basically, what we want to draw from that isn't that small moves are associated with spikes in the VIX. It's just at slow, steady moves, predictable moves in the S&P 500 are not associated with spikes in VIX. So right here, for example, I would call it somewhat fast, but right here, let's say Tuesday, Friday, the 29th, all the way down to January the 4th. Friday the 29th to January the 4th. See, we have a rise in VIX, but rise to the top of the normal range. It wasn't a big spike. It wasn't like this day, February 13th. Let's see what February 13th looked like. Okay, so this was a gap down from the all-time high at the moment all the way down to the EMA 20 in a single day. So that was a spike. But if we just go, oh, we tick down, we get closer to the EMA 8, we touch the EMA 8, we go in between the EMA 8 and the EMA 20, and then we touch the EMA 20, that is an orderly and predictable movement downwards. And so you wouldn't get that huge spike. You get an elevated VIX, but not a huge spike. So if from here, we just very orderly, just tick down, we could tick down all the way to the MA 200. If it was nice, slow, and steady, we wouldn't get a huge spike in VIX. So we wouldn't, just because we're down here doesn't mean that we're going to get a big spike in VIX, even if we move lower in the S&P 500. What we would be looking for is some sort of catalyst or unexpected news that would drive us higher. And of course, there's always risk of that. There's always a chance of that because unexpected news is unexpected. It wouldn't be something that we wouldn't be able to predict. So we're going to watch VIX just to see if we hit above this 15 and a half level, then we're really going to start paying attention just in case VIX starts to fly upwards and we get a downward motion in the S&P 500. Right now, what's happening is all last week and maybe a little bit before last week, we were talking about the stronger possibility of us chopping in between the MA50 and MA90 and then breaking down and giving us that 10% correction. And so instead, what happened is we're chopping just above the MA50. And then if we keep up, if we can't break through here for a long enough time, then the market's going to get worn out and then start moving back into this range. And then we'll be talking about the possibility of breaking that MA90 or this 500 level again. And then the possibility of us moving back down to this 475 level or MA200. So that's not off the table. What we talked about a week ago, a week and a half ago, that's not off the table. It's just manifesting itself in a slightly different form than what we were expecting. So if we don't get a breakout, if we don't get a catalyst soon, then we may just peter out and come back down. The most visible possible catalyst for the market, I believe we identified for next week. Or oops, that's not what I want to do. Or Tuesday, I think next Tuesday, May 14th, PPI, and then Wednesday CPI. So or core inflation, not quite the same thing as CPI, core inflation. So those inflation numbers may give us a catalyst and may move the market, but before Friday, before the end of this week, we don't really see it. So we'll take a look at TLT, see what that's doing. Looks like we hit a peak right here and then came down. Looks like we're going to open a little bit further down. And when we look at this, we got this downward movement into the bottom of this channel, spike up to the top, downward movement, spike up, downward movement to a horizontal spike up, downward movement, and we stayed a little bit longer at the bottom of this channel, and now we're spiking up. We just didn't hit the top of the channel. Looks like we're starting to move back down. This is looking like, especially if we can break below this gap right here, right, from this 88.8 up to 89.4. If we can get down into this level, then we'll probably move back down into this channel. So let's see what could cause that. We had this upward movement. We had the FOMC rate decision last week, and for whatever reason, the market interpreted it as, hey, it's time to send these bonds back up. We're going to get a rate cut. Even though Powell very distinctly said, we're probably going to wait. After Powell said that all last week and this week, we've been having Kashkari and a bunch of other Fed speakers say it is very interesting what they're saying now. They're not talking about rate cuts anymore. They're talking about, oh, it's, we'd rather hold rates at elevated levels rather than increase rates. They're not talking about lowering rates anymore. It's not in their language. In the last few speeches that we've gotten in the last week, they've talked about, oh, we're not going to raise rates. We'd rather keep them elevated where they are right now rather than raise rates. So that's a very distinct and important change in their language that should be sending probabilities priced into this market way down. And as of right now, June is still sitting at 91.5%, and July is still at, well, I guess I should have said it should be at 8%. And then over here, July is still at 33%, 33.1%. It actually went up today, which is crazy to me. Maybe they're reacting off of that jobless claims, but it's crazy. But what the Fed speakers are saying is our economy is too good. It's so good that it's keeping inflation up. None of the inflation numbers so far in 2024 have been good, have been indicating that inflation is coming down. In fact, the last few reports show that inflation is coming up. So in order to get our inflation down, we've got to cripple our economy. That's what they're saying. Our economy, we want to slow down our economy. We want more people out of jobs. We want more people unable to spend. So these probabilities are way too high. They don't reflect what the Fed is saying and very much looking like they're going to do, unless you're expecting, for whatever reason, this would be the gamble move. Right? It's the roll of the dice, the unable to analyze move. It's gamble because it's not known, it's not calculatable. The gamble move is the Fed is going to go political and do a rate cut in order to help out. For the most part, it would help Biden out if they're going to do that. So if we ignore the politics, this probability should be lower, should be in the 10%, maybe even a little bit lower range. So what is our deadline here? July 31st. We have not quite 2 months for these probabilities to go way down to this maybe 8.5% level, maybe lower to zero. It's extremely unlikely that we're not going to get a rate cut by July 31st. If we do get it, it'll be probably towards the end of the year. One rate cut is still on the table. I've been telling you guys for a few weeks now that probably zero to one is probably the more accurate estimate. So that one isn't going to come in July. If it comes, it's going to come in November or December. So that means this is over enthusiastically priced. Over the last couple of days, we're starting to see it come back down into reality. But if that July number does go down towards zero, what does that mean for where TLT will go? It's going to go down probably below this consolidation period. It's going to go down to the bottom of this channel or maybe below it. Just like over here at the end of December, everyone was saying 6 rate cuts in 2024, 6 rate cuts in 2024. And then we got the July decision, and then the Fed told us, no, not 6, 3. And then this is what happened. And then for whatever reason, we got excited again. Oh, we're going to have, I don't remember in February what they were, I think they were still pricing in 6. And the Fed was like, no, 3. And then we did this. And then we popped back up over here for whatever reason. We got enthusiastic at the prospect of 3. And then we got a reality check. I don't remember what it was at that time. That was probably around the time where they started talking about 1. And then we came all the way down here. And now that's where we are today. And the Fed is now saying, we don't want to raise rates. They're not talking about cutting rates anymore. They're just saying, I don't want to raise rates. So at some point, the probabilities will match the reality. And that means for us, well, it either suddenly the Fed says, oh yeah, okay, we'll start cutting rates, or they stay where they are and the market realizes that rate cuts aren't coming. So a short TLT is actually a pretty good idea right now, especially if we go into this gap over here. So we'll probably hit, if we go in the gap, there's not that much room to this horizontal level. There's a little bit of room to the bottom of the channel. And at this point, it's not clear whether we would move below the bottom of the channel. So we're really counting on this downward motion to the bottom of the channel. So that would make a decent trade. And since we don't have too much to talk about, we might as well see if there's an interesting option for that. July 31st, so we'd go into August. Might be a little bit more of a larger investment, so we would want to be careful with this, depending on your account size, of course. So let's take a TLT. Options. We want to go into August. If I just buy an at the money put, not $200, that's probably affordable. So basically, On this trade, we'd be asking ourselves, if this option went to zero, would it be devastating for me? Or would it be devastating to my account? If I have a $10,000 account and I lose $200, that's kind of noise in my account. If I have a $2,000 account and I lose $200, that's 10% of my account. That's probably about the maximum you would want to lose in a single trade. And then, so obviously, if I had a $1,000 account, then it'd be too much. I'd be losing 20% of my account just in that trade. So you want to evaluate very carefully whether or not the size of your account can handle if we allow this to go to zero. And why do we do that? Yeah, we might have intentions of getting out, but sometimes we have difficulty getting out of positions and it erodes further than we expect it to in the process of us trying to get out of that position. And in general, as things get, if this thing goes down, it's because the TLT is going up. And that means that the strike that we have is further and further out of the money, and liquidity tends to go less the further you go out of money. So for example, here we have a 225, 221 market. That's only 4 cents up here. But if I go up here, that we have a 60.57 market, and arcane, that's smaller, that's 3 cents. Yeah, but that's 3 cents off of 60 cents. So that is what 5%. Whereas 4 cents off of 5 is, well, about two. My brain is too foggy this early in the morning. 4 cents off of 224, that's about 0.6%. Okay, so 2% versus 0.6%. Yeah, it's a much more significant lack of liquidity when we go further out in the money. So we want to be careful with this. For this, going that far out, I'd prefer to do a 1% extrinsic value trade. So I'm just going to use a different option table so I don't have to do all the mental math in my head and figure out what the 1% extrinsic value would be, well, strike would be. And so we're looking for an extrinsic value of about 90 cents. So we'd probably go into this 92, 93. And 92 is comfortable because that's about $1.15 of extrinsic value, but we have more than 1 month. So we have about 2.5 months, a little over 2.5 months in order to get just to move 1% down or just over 1% down, which is fine. So here, can your account handle a $330 loss or $325 loss? And if it can, then this is a pretty good trade right here. I might put this trade on in one of my accounts, actually. I like it quite a bit. Now let's put this into option strat and buy a long put for August in TLT at a 92 strike put. And let's see why it's giving an exclamation mark. Low volume. That's okay. We don't expect a lot of people to have identified this as a good trade. So that's fine that it's low volume as long as it's not a terrible bid ask. And we already saw that's only 4 cent bid ask spread. This is totally acceptable in terms of liquidity. So 325, that's the same thing we saw on the other option table. So we'll go ahead and save this trade in the pre-post market. Excellent. All right, we're 5 minutes before the market open, so we'll just end it there. And we got a interesting trade idea out of this session at least. Have a wonderful day, and I will see you in the post market.